Climate change is no longer a far-off problem. It is happening here. It is happening now. A very good afternoon to one and all present here. I am Mehak Agarwal, and my topic for today is regulatory measures on climate change. Now, while we are all already aware of the term climate change, yet if I were to describe it in a single line, I would say it is the long-term changes in weather patterns. Since climate change relates to the environment, the discussion from here onwards will relate to regulatory measures with respect to the environment. What has contributed to climate change has well been described by Bollywood itself, whether it be Pani Re Pani Tera Rang Kaisa, that is water pollution, or Dhua Dhua Si Hai Zindagi, that is air pollution, or Jia Jale Ja Jale Pero Tale, that is global warming. These are all in fact contributors of climate change. The effects of climate change range from hotter temperatures, rising sea levels, loss of species, and severe impact on human beings. Having said that, in order to mitigate the ill effects of climate change, India has set several targets for itself. These include shifting to non-fossil electricity generation, reducing carbon emissions, and achieving the target of net zero by 2070. Having given you a brief description of the topic, I will now come to the core of my topic. Now, we already know of several environment regulations that already exist in India, whether it be the Air Act, the Water Act, or the Protection of Environment Act. Then, why am I talking about the need for further regulations? The answer to this is here. Under this, I will be discussing two main points. Number one, the MOEF, that is the Ministry of Environment, Forest and Climate Change. While the MOEF was supposed to be an independent body, it faces a lot of interference from the government. This is to say that if the MOEF decides not to grant sanction to a particular project, yet the government might interfere if the government feels that such a project is likely to increase its own revenue, even though it may be at the cost of the environment. As such, MOEF ceases to be the independent authority it is supposed to be, and hence ceases to exercise independent judgment. Here, another important point to discuss is that the existing laws in India follow a command and control structure. Now, what is a command and control structure? Under the command and control structure, specific standards or limits are set. In case of non-compliance with these standards, a penalty, fine, or imprisonment is imposed on the company. While this may prima facie sound to be a very good structure for regulating the activity of an organization, I believe that one of the major drawbacks here is, while those companies who are not complying with the standards are punished with sanctions, in case of those who are complying with the standards, there is no incentive to continue to do so. Apart from this, the lack of political will and public awareness, human-centric laws, and lack of strong penalty measures have made the existing regulations in India very ineffective. While the scope of discussion today could be very large, I am limiting this to acquainting us all with those topics which we, as part of corporates, should be aware of. Now, I am dividing my topics into two major discussions. Number one, those responsibilities which have been imposed on corporates, and number two, incentives provided by the government. Again, in respect of responsibilities which have been imposed on corporates, I will be talking about those which are obligatory in nature and those which are regulatory in nature. Coming to the first segment of my discussion, that is corporate responsibilities which are obligatory in nature. Here, I will again be discussing two major points. Number one, BRSR, and number two, CSR. The first topic, that is BRSR. Now, what is BRSR? BRSR stands for Business Responsibility and Sustainability Reporting. It is a report or a disclosure that companies are required to provide. Where? In their annual reports. And such a disclosure states that the activities or operations of the business are sustainable and responsible. BRSR was originally called BRR, that is Business Responsibility Reporting. The principles of BRSR have been derived from the National Guidelines on Responsible Business Conduct. While BRSR consists of 9 principles, I will be limiting today's discussion to the environment-specific principles of BRSR. These are Principle 2 and Principle 6. Now, Principle 2 states that businesses should provide goods and services in a manner that is sustainable and safe. How can businesses ensure that? In this respect, businesses can have a policy. The policy, say for instance, may provide that the businesses are required to change their machineries at a particular interval of time. For instance, the policy may state that a business is required to change its machine every 10 years. We all know that the older a machine gets, the more obsolete a machine gets, the more fuel it is likely to consume. This will have a direct impact on the environment. Accordingly, having a policy for regularly monitoring and changing your machines would be a good way of complying with this principle. Another important term to understand here is sustainable sourcing. Now, what is sustainable sourcing? It means sourcing your raw materials from suppliers or in a manner that is sustainable and safe for the environment. This could involve using the waste products of one company as your own raw materials, or it could also mean shifting to renewable sources of energy. Coming to Principle 6. Principle 6 requires businesses to respect, make efforts to protect, and restore the environment. Here, one important term to note is environment impact assessment. This means that businesses are not limited to their activities only, but have to go a step ahead to also see the actual impact of their activities. Having said that, while BRSR is not something that is directly contributing to or helping me mitigate climate change, it is imposing responsibility on the top 1,000 listed entities, that is, the biggest entities in the country, to show that their activities are responsible and sustainable towards the environment. Having said that, I would also like to mention that various countries, including India, are now opting for a more disclosure-based regime so as to ensure or impose a sense of accountability and responsibility on businesses. Based on the BRSR, the ICAI has also developed a model. This model, that is the SRMM model, enables companies to compare their performance or their sustainability standards with those of international companies and accordingly take measures to improve themselves. This is a very unique concept and ICAI has also applied for its trademark. Coming to the second topic of discussion under obligatory responsibilities is CSR. Now, Section 135 of the Companies Act 2013 talks about CSR. We all know it also provides a list of activities under Schedule 7, which are activities that will qualify as CSR. Item number 4 here specifically talks about the environment activities. While it has been seen that the expenditure CSR expenditure when it comes to environment activities has been very low as compared to expenditures which are taken for child empowerment, women empowerment, education. Yet, it has also been seen that there has been a growth in CSR expenditure on environment over the years 2015 to 2020, with a slight drop in 2021, obviously owing to COVID-19. Coming to the next segment of my discussion, that is those corporate responsibilities which are regulatory in nature. Here, the first two topics of discussion, that is green deposits and green bonds, are part of sustainable finance. The detailed discussion on this will be taken up in another session. However, I will still introduce the topic to you. Now, like I mentioned in one of my introductory slides, that India has set certain targets for itself. Achieving these targets will require finance, and India at present is already running in a deficit of finance. In order to bridge the gap between achievement of objectives and availability of finance, green deposits and green bonds play a very important role. Now, what is a green deposit? A green deposit is made by persons like us, that is investors. Investors deposit money with a regulated entity. Who are regulated entities? They may either be banks or NBFCs. Now, what do banks and NBFCs do with this money? They further on-lend such money for environment-friendly activities and other environment projects. The list of various banks who have accepted green deposits is visible in front of you. Under sustainable finance, we also have the concept of green bonds. Now, what is a bond? A bond is an instrument that is issued for the purpose of raising some funds. So what is a green bond? A green bond is a bond that is issued for the purpose of raising funds for environment and climate projects. Early this year itself, the government of India had come out with the issue of the first tranche of green bonds and raised 80 billion worth of money via it. The funds raised via these bonds are then used to fund various hydro, solar, and wind projects. Now, the commonality between green bonds and green deposits is that both provide for third-party assessment and utilization disclosures. Why I'm emphasizing this again is because most of the regulations that are coming out today are emphasizing the need to monitor or to see the actual impact on the environment. To repeat myself, This means that businesses are not to limit themselves to what activities they're undertaking, but also to see, check, and follow up as to what actual impact their activities have created. Under regulatory obligations, my next topic of discussion is Energy Conservation and Building Code, which I will now be referring to as ECBC. Now, the building sector in India consumes about 30% of the total electricity in the country, and it is the second largest emitter of greenhouse gases. Having said that, it was necessary to have a regulation specifically designed for the building sector. It was here that ECBC found its role. ECBC was enacted in 2017, and the code provides for the commercial buildings to have certain new design structures. For example, the buildings could be designed in such a manner that they have greater access to solar light so as to reduce dependence on electricity. Or instead of using electricity run geysers, the buildings could opt for solar heaters. Here in front of you, I have also mentioned a survey that was conducted in Ahmedabad, where it was seen that ECBC has been very effective in reducing energy consumption, power consumption, as well as carbon dioxide emissions. Apart from that, also note that India ranks second in the world when it comes to green buildings. This definitely shows how effective the code is. Coming to the next and one of the most important topics of discussion for today, that is carbon credits. Let us first understand the concept of carbon credits. Say, for instance, there is a certain set standard, that is 100 tons of carbon dioxide emissions. There is a company A that is able to operate below these standards. That is to say, it is able to limit its carbon emissions to only 50 tons of carbon dioxide. For operating below the specified limits, it gets carbon credits. On the other hand, there's a company B, which is operating way above these limits. Say, for instance, the emissions of company B are 150 tons of carbon dioxide. This company B can then purchase the carbon credits of company A to set off its excess emissions. This is the concept of carbon credits. Now, the concept of carbon credits was first conceptualized in the Kyoto Protocol. What was the Kyoto Protocol? It was a meeting of various countries around the world where the main agenda was to reduce carbon emissions. Now, the Kyoto Protocol provided for CDM, that is a clean development mechanism. Under the clean development mechanism, various countries from around the world could register themselves and engage in the international trading of carbon credits. India has been a very active participant when it comes to the international trading of carbon credits. At the same time, the Kyoto Protocol also provided that countries could have their own domestic carbon trading markets as well. India, till very recent, did not have its own carbon trading framework. However, with the recent Energy Conservation Amendment Act, the Carbon Trading Scheme 2023 was introduced. However, the detailed legislative framework is yet to be notified. India still does have some own market-based approaches. What are these? Number one, Perform, Achieve and Trade mechanism. And number two, Renewable Energy Certificate Scheme. Now, what is a Perform, Achieve and Trade mechanism? Under this, specified sectors are provided specific energy standards. Again, if the companies are able to operate below these energy standards, that is, they are able to reduce their energy consumption, then for operating below this limit, they get energy saving certificates. These certificates can then be traded on the exchange of the Ministry of Power. A similar concept, that is Renewable Energy Certificate Scheme. Now, the main motive or the main purpose of this was to promote the use of renewable energy. So, here certain energy standards are set again. You are required to produce a particular proportion of the energy by using renewable sources only. If you manage to do that, you get renewable energy certificates, which again can be traded on the exchange of the Ministry of Power. Coming to a similar concept, that is Green Credit Program. Now, the major difference between green credit and carbon credit is that while carbon credit was limited only to reducing carbon emissions, Green Credit Program covers a wide range of activities which are environmentally conscious and sustainable for the environment. Having said that, another important point to note here is an activity which qualifies for a green credit may at the same time also qualify for a carbon credit. This means that from the range of activities that are visible in front of you right now, if there's a particular activity which can get a green credit, and at the same time that activity can also help you reduce carbon emissions, then you not only get a green credit for it, but also get a carbon credit for it. With this, I have completed the discussion on the first segment of my presentation. I will now be moving on to the second part, that is various incentives provided by the government. Now, while the government provides various incentives under various sectors, I am today focusing on those sectors which are the biggest or the highest contributors when it comes to climate change. The first topic here is mobility. Now, vehicles that run on fossil fuel are one of the largest contributors of carbon dioxide into the atmosphere. In order to ensure or in order to promote the use of electricity run vehicles, the government brought the FAME scheme. What is the FAME scheme? It stands for Faster Adoption and Manufacturing of Electric Vehicles in India. Under the FAME scheme, in order to promote the purchase of EVs, that is electric vehicles, the government provides a 40% subsidy on locally manufactured electric vehicles. This subsidy has, however, now been reduced to 15% to ensure greater participation. FAME scheme, however, has its own drawbacks, which I will be coming back to later. In the field of green construction, the government is providing 100% depreciation on the cost of green building assets. Remember, we discussed green buildings under the ECBC code. So the assets that are used in these green buildings will be eligible for 100% depreciation. Further, the loans that are provided for construction of these green buildings are also at a very low rate of interest. At the same time, their approval mechanisms are also faster. Under green energy, we are all already aware of the National Hydrogen Mission launched by the government. At the same time, the Atal Jyoti Yojana, where the main purpose was to install solar street lights and solar study lamps. Here, I would also like to discuss another important term, that is viability gap funding. What is viability gap funding? Now, it may so happen that a project has the capability of doing very well, but it does not have the funds to survive or grow. In this case, in order to bridge the gap between availability of funds and continuance of the project, the government provides funds to such projects. This is known as viability gap funding, which means the government provides funds in order to make a project viable. Coming to the specific incentives that are provided under the Income Tax Act and the GST Act. Now, under the Income Tax Act, the general depreciation on machines that is available under Section 32 of the Act is a 20% depreciation. However, if you are somebody who is engaged in the manufacturing of solar power plants, you get an accelerated additional depreciation of 40%. This means you were already getting a 20% depreciation. Now you also get an additional 40% depreciation, which makes it a total of 60% depreciation. Apart from this, in case you're engaged in the manufacturing of renewable energy power plants, the government is also providing a 10-year tax holiday. What does this mean? It means that you will not be required to pay tax under the normal tax provisions for a continuous period of 10 years. You will, however, still be required to pay tax under the minimum alternate tax mechanism, which will range between 20.4 to 21.4%. However, such MAT credit can subsequently be adjusted when you start paying tax from the 11th year under the normal provisions. Apart from this, if the environment activity that you are engaged in is such an activity which is also covered under Section 80IA of the Income Tax Act, you get exemption on 100% of the profits for the first 5 years and thereafter 50% of the profits for the next 5 years. Apart from this, under the GST Act, there are various exemptions for batteries, inverters, wind turbines, solar panels, and even electric vehicles. Now, every country has its own climate legislations, its own way of mitigating climate change. They have their own net zero targets. However, comparing India with other international countries, India is still lacking somewhere. Let us discuss one such area where India is lacking. Here comes the concept of carbon tax. Now, what is carbon tax? Carbon tax is a penalty that is levied on businesses for excessive carbon emissions. Let us not confuse it with carbon credits. Remember, carbon credits was a positive term, whereas carbon tax is a negative term. Under the concept of carbon credits, we said that if the company is able to operate below a certain standard, it gets carbon credits. Under the concept of carbon tax, we are saying if the company breaches a certain limit, it has to pay carbon tax. The concept of carbon tax already exists in several countries, including Sweden, Norway, Finland, France. But India still does not have the concept of carbon tax. Why is this so? One of the major reasons why India does not have a carbon tax concept is because it does not have a carbon pricing mechanism. This means it is pretty clear that we can only impose tax on something that we can price or that we can attach a value to. India does not have a way or a manner in which it can attach a value to its carbon emissions. If we cannot attach a value to carbon emissions, how are we to tax it? Accordingly, India still does not have a concept of carbon tax. However, if India were to have the concept of carbon tax, how would it help it? Number one, it would obviously disincentivize the use of fossil fuels. Secondly, a tax is an added revenue for the government and hence additional revenues for the government. Thirdly, the increased tax rate by imposition of carbon tax will motivate businesses to reduce carbon emissions. Accordingly, it will lead to lower health costs and ultimately economic growth. But the road is not going to be easy. There are certain challenges also that India will have to face when it comes to implementation of the concept of carbon tax. What are these? First and foremost, any sort of tax is likely to increase the cost of production for industries. If the cost of production rises, the businesses will also sell their products at a higher price and accordingly higher price for consumers. Apart from this, most of the electricity in India is generated by burning coal. Burning of coal releases a lot of carbon dioxide. Therefore, imposition of carbon tax will have a direct impact on electricity generation from coal. Having discussed these, another important point here is there are various small and medium enterprises in India. Those enterprises which are highly carbon intensive, but they either do not have the resources or the expertise to monitor such carbon emissions. Accordingly, collecting data from such businesses would become quite a task. In that case, what should India do? What is the way to go about it? The first step here would be to determine an appropriate tax rate. That is to say, an equitable tax rate. Now, if you're imposing a tax, the majority of the population in India is the middle class population. So if you're imposing a tax which is likely to increase the cost of living for such population, you also have to set it off by providing some sort of subsidy to them. Apart from this, the carbon tax regime will have to be integrated with the existing tax regimes in the country. With this, I move to the last part of my discussion. No law, no scheme, or no regulation is ever foolproof. Having said that, the FAME scheme also has its own drawbacks. The recent controversy that has been seen under the FAME scheme is that manufacturers, instead of domestically producing the EVs, are procuring them from countries outside India, especially China, and are claiming subsidies on them in India. This is defeating the very purpose of this. Apart from this, like I discussed earlier, CSR expenditure in relation to environment is still very low. Only about 6.84% of the total amount has been spent on CSR when it comes to the environment activities. Climate change is not a one-man job. It will require efforts from all of us. As they say, boon boon se sagar banta hai. And I believe with a combination of human conscience, corporate actions, and government incentives, we will definitely be able to make this world, if not a better, a more habitable place. Thank you.